Welcome back to another episode of Market Brief After Hours. It has been a turbulent Thursday, to say the least. If you are watching the screens today, you saw a sea of red that seemed to stretch across almost every time zone. We've got escalating geopolitical tensions, a spike in oil prices, and investors running for cover.
It really was one of those days where the headlines dictate the price action entirely. The catalyst, of course, is the Middle East. We saw reports of tanker attacks in the Persian Gulf, and that immediately reignited fears about energy supply disruptions. When you combine that with some already fragile sentiment, you get the broad sell-off we saw today.
Let's get right into the numbers because the damage was significant, particularly for the industrial heavyweights. Walk us through the U.S. close.
It was ugly for the Dow Jones Industrial Average. That index took the brunt of the hit, slumping 785 points, rounding to the nearest whole number there. That is a 1.61% decline, leaving the Dow at 47,955. The selling there was really driven by names like Boeing and Caterpillar. These are companies that are incredibly sensitive to global growth. So when the world gets nervous, they get sold.
And the S&P 500 didn't fare much better?
No, it didn't. The S&P 500 finished the day down 0.56%, closing at 6,831. It actually started the day trying to stay above the flat line, but as those crude oil prices kept climbing, the energy-related volatility just weighed down the broader sentiment. It eventually succumbed to that pressure.
Interestingly, the Nasdaq seemed to hold up a little better than the rest.
Relative resilience is the key phrase there. The Nasdaq Composite dipped 0.26% to close at 22,749. It's still a loss, but compared to the Dow, it's a victory. The saving grace was the semiconductor space. We saw strength in some tech heavyweights that helped pull the index up from its lows, which were down around 1.4% at one point during the session.
So the U.S. struggling, but looking across the Atlantic, it seems Europe had an even rougher time.
Europe was hit hard. The proximity to the geopolitical issues and the reliance on energy imports always makes European markets more sensitive here. The Pan-European Stock 600 fell 1.4%. If we look at the major national indices, it was a decisive slide. Germany's DAX declined 370 points. That's a 1.53% drop to close at 23,835.
And France and the UK?
Same story. The CAC 40 in France dropped 112 points to 8,055. Across the channel, the UK's FTSE 100 slid 159 points to finish at 10,408. Italy's FTSE MIB was down 603 points.
I noticed Spain took a hit as well, but there was a specific diplomatic angle there, wasn't there?
That's right. The IBEX 35 dropped about 1.4%, but tensions were exacerbated after U.S. President Donald Trump criticized Spain. Apparently, Spain refused to allow American forces to use its bases for strikes on Iran. That added a layer of diplomatic friction to the economic anxiety.
It's worth noting that the economic data coming out of Europe was a mixed bag today, too.
Very mixed. On one hand, you have Eurozone retail sales unexpectedly falling 0.1% in January. That signals fragile consumer demand. But then you look at Italy, where retail activity was strong, up 0.6%. And Ireland is just operating in a different gear entirely. GDP growth of 12.3% in 2025, largely thanks to pharmaceutical exports. But right now, the war drums are drowning out the economic data.
Now, before we move to commodities, we have to talk about Asia, specifically South Korea. Amidst all this global selling, South Korea did something dramatic.
This was the anomaly of the day. While most markets were selling off, the South Korean KOSPI surged a massive 9.6% to close at 5,584. At one point, it was up 12%. This was the strongest daily gain since 2008.
That is unbelievable volatility. What caused that massive reversal?
It was a classic snapback rally. Earlier in the week, the market had been decimated by forced selling and margin liquidations. Today, that reversed. Investors rushed back in to buy the dip, particularly in tech. Samsung Electronics and SK Hynix both rose more than 10%. It wasn't necessarily about the geopolitics, it was a market structure event, a massive unwinding of short positions.
Let's pivot to the root cause of today's anxiety, oil. We saw a sharp jump.
We did. The fear is that the conflict will disrupt shipments through the Strait of Hormuz. That is a vital artery for the world's energy. U.S. crude climbed to settle at $79 per barrel, though it briefly cracked the $80 level during the session. Brent crude ended at roughly $84. This puts both benchmarks on track for their strongest weekly gains since 2022.
And that trickles down to the consumer immediately.
It does. The national average for gasoline in the U.S. has already ticked up to $3.25 per gallon. And for investors, higher oil prices feed directly into inflation concerns, which brings us to the bond market.
Right, we saw Treasury yields moving higher today.
Exactly. When oil goes up, inflation expectations go up. The 10-year Treasury yield rose to around 4.13%. The 30-year is up to 4.75%. Investors are looking at rising energy costs, combining that with some strong productivity data we got, and realizing that the Fed might have to keep rates elevated for longer.
We're going to take a quick break. When we come back, we'll dive into the technicals on the Forex market, specifically those moving averages everyone is watching, and we'll look at the individual stocks that made big moves today. Stay with us. Welcome back to Market Brief After Hours. We've covered the equities and the oil surge. Now let's get technical with the currency markets. It looks like the euro is in some trouble.
The euro is looking very heavy. The euro-USD pair closed at 1.1603, down 0.26%. But the real story is the technical damage. It confirmed a decisive break below all its key moving averages.
Can you give us those specific levels?
Sure. It broke below the 200-day simple moving average at 1.1667. The 100-day at 1.1696, and the 50-day at 1.1768. When you slice through the 200-day like that, it signals a notable shift in momentum. The bulls have lost control. The next downside target is the psychological 1.1500 level.
What about the British pound? Is it seeing the same weakness?
Similar story. GBP USD closed at 1.3360. It's struggling to sustain any rebounds. It is trading below the 100-day SMA at 1.3398 and the 200-day at 1.3445. The short-term bias is definitely tilted to the downside here, with sellers retaining control.
And on the flip side, the Japanese yen seems to be weakening against the dollar, or rather, the dollar is strengthening against the yen.
Yes, USD JPY pushed higher, closing at 157.57. This trend is very much intact. It's trading comfortably above its 50-day SMA at 156.05 and the 100-day at 155.33. As long as it holds those higher lows, the focus is on the upside, potentially targeting 159.00 next.
Let's quickly touch on precious metals. Usually when there's geopolitical strife, gold rallies, but it retreated today?
It did, which is interesting. Gold closed at $5,078, down 1.22%. It formed a large bearish candle. However, we have to zoom out. The uptrend is still firm. It remains well above the 50-day SMA at $4,942 and the 200-day way down at $3,975. This looks like a pullback after a strong rally rather than a reversal.
And silver?
Silver took a harder hit, dropping 1.8% to close at $82.01. The concern here is that it dropped below its 50-day SMA at $84.90. That signals some short-term momentum weakness, but like gold, the broader trend is positive as long as it stays above the 100-day average at $69.29.
All right, let's finish up with the market movers. Despite the sea of red, there were some individual stocks making massive moves based on corporate news. The trade desk had a phenomenal day.
A rocket ship. Shares of Trade Desk surged 19%. The catalyst was a report that OpenAI has engaged in preliminary discussions with them to facilitate advertising sales. Any association with OpenAI right now is gold dust for a stock, and the market loved this potential partnership.
Broadcom also bucked the trend.
Yes, good old-fashioned earnings beat there. Broadcom gained 5%. They reported adjusted EPS of $2.05 and revenue of $19.31 billion. In a semiconductor sector that is showing strength, Broadcom remains a standout performer.
But it wasn't all good news. Grocery Outlet took a massive hit.
That was painful. The stock plummeted 27%. They missed earnings estimates, and more importantly, their full-year outlook fell short of Wall Street projections. In this environment, if you guide lower, you get punished severely.
And we saw some retail weakness with American Eagle and Victoria's Secret, too.
American Eagle fell 14%. They actually beat on revenue, but management highlighted significant margin pressures coming from newly announced global tariffs. That spooked investors. Victoria's Secret slumped 12% after issuing a free cash flow forecast that was substantially lower than consensus.
It really highlights how selective this market is. You can't just rely on the broad indices. The individual stories matter immensely.
Absolutely. But looking ahead to tomorrow, the macro picture takes center stage again. We have the February non-farm payrolls report coming out.
That's the big one.
It is. With the mixed labor market signals we saw today, jobless claims steady but unit labor costs rising, investors need clarity. If the jobs report is too hot, it reinforces the inflation fears driven by oil. If it's too cold, growth fears take over. It's going to be a pivotal moment for the direction of monetary policy.
We will certainly be watching closely. It's been a volatile week, and tomorrow could bring more fireworks. That wraps up our coverage for today. If you find this useful, please follow Market Brief After Hours. We'll catch you next time.